Good morning, everyone, and welcome to Mobile Payments Conference 2021. I'm Scott Goldthwaite, President of AliasWire. We're thrilled to sponsor MPC once again this year. Last year, we did receive the Visionary Award for Pavis, our small business credit card issuing platform designed specifically for ISOs and acquirers. The response from last year's conference attendees was amazing, and this innovative product continues to disrupt the small business credit card market. This year, with MPC's outreach to banking and financial institutions, we're changing up the topic a bit. And we're going deeper into banks and Fintechs competing and partnering in the market for electronic payments. First, some housekeeping. If those of you that are logged into the Huva platform here, there is a Q&A section just off to the side, so feel free to start typing in your questions as we go. And I'll get back to as many of those at the end of the session. JPMC's Jamie Dimon is known for his colorful language regarding banks and Fintechs, and I'm sure you've all seen this quote here at some point before. This highlights the complicated and often tenuous relationship between banks and Fintechs. While Fintechs need banks to operate, in many cases, Fintechs end up competing head-to-head with banks, and more often relegating banks to only providing basic cash management services and BIN sponsorship. The relevant point here is that banks are playing an increasingly smaller role in the financial community. While many banks are focused on generating new sources of non-interest income, fee revenue income, many banks are focused on generating a strategy that's at odds with this. As banks become a smaller player, it's going to be very difficult to achieve fee income revenue as they start to get squeezed out by Fintechs. For example, many of our bank's top commercial clients are in the insurance industry. If you saw that recent report by Forbes, there's over 50 Fintechs now that have entered the insurance industry in the last 3, 4, 5 years. Here are just a few on this screen. These Fintechs are competing for your insurance clients because they offer a better user experience and advanced technical capabilities. Some of these, like One Inc., for example, are directly competing with banks to provide advanced payment processing to insurance companies, often going around the banks to do this. This results in a loss of fee income revenue for the banks. Insurance is just one example. Bank treasury clients in healthcare, utilities, consumer finance, property management, municipalities, they're all getting called on by dozens of Fintechs every day in each one of these vertical markets. So why is that? Most of the banks don't have the resources to build and invest in advanced payment applications beyond core banking services that their enterprise clients need, particularly in payments. As a result, a huge Fintech industry has grown up and to fill this gap. So here's part of the problem. How are Fintechs taking such a giant lead over banks? Well, a few important reasons. Fintechs are great at telling a story, and they're heavily focused on the user experience, the user interface, the look and the feel. They do great demos. They never say no. And their solution is very targeted to a very specific use case. This is exciting to their prospects, which are the digital marketing side of the enterprise client that they're selling into. In contrast, banks often talk about security and compliance and treasury management. Not exciting at all to digital marketing people. However, the underlying dynamics are very important. The fun and exciting stuff items are not the most important to the operational side of the business. While Fintechs are unencumbered by the practical operation realities of the day-to-day business, The boring stuff, such as bank reconciliation, cost of operations, and integrated receivables, that becomes very important to the IT operation and the treasury management folks at the enterprise who are charged with managing a payment solution long after the fintech is gone. The good news for banks is that they are much more aligned with the treasury and operations side of the business and have great access to these teams. Within this defined problem, there's an opportunity for banks to offer their treasury clients a best-in-class integrated receivables offering without having to invest in in-house application and product development. The solution here is to partner with a fintech instead of competing with them. By collaborating with the right partners, banks can deepen client relationships by delivering innovative solutions while tapping into additional fee revenue streams. So, what is a healthy partnership? Alignment is critical. Banks and fintechs have to understand how each other make money. That's the most important step here. There's models where it's a joint sale or a referral or a reseller type model. They're all very completely different and have different impact on how a bank goes to market. If these business models don't align, the partnership will not be healthy. Other important factors are commitments to time and resources to keep the partnership moving. So what are some examples? Zelle is a great example. By now, Zelle is a familiar name to the banks. It really is a partnership between a technology entity and thousands of banks. Via the Zelle partnership, banks both large and small have created a peer-to-peer network that rivals all the other fintech competitors, including PayPal and Venmo and others. Without that type of partnership, it would be really hard for banks to compete with those other fintechs that are out there. Another good example is TD Bank and Flybits. They partnered with Flybits to deliver a rich mobile banking experience that is fully integrated with TD Bank. Another example, City National Bank. They partnered with Extend to provide an enhanced virtual card program to the bank's existing commercial card clients instead of building that out themselves. Here at AliasWire, we have a number of success stories helping our bank channel partners compete and win against fintechs, helping them drive significant transaction fee revenue. So how do you choose the best match? Most importantly, not only banks need to be fintech friendly, but fintechs need to be bank friendly. For fintechs, this means they should white label the solution and bring the bank's brand up front. Fintechs also need to make the contracting process very simple. The way this happens simply is passing their terms and conditions and contracts through the bank's paperwork. So that the underlying client doesn't have to sign two sets of agreements. That becomes very complicated and it slows down the cycle. Fintechs do need to be prepared to go through the bank's extensive and rigorous vendor due diligence process. This can take a lot of time, and in many cases, that due diligence process can take longer than an actual implementation and contracting. For banks, though, this means that the banks need to understand these systems so that they can provide level 1 support. The last thing a bank wants to do is give out another phone number or an email address or a whole nother system for their clients to settle up with customer support problems, ask questions. The bank really needs to take that front end to make it seem like a seamless solution. Let's go back to the vendor management process for a second. Banks have this complex process. It can be lengthy. We certainly suggest that banks take a little different look at this, perhaps create a fast path to due diligence, try a pilot program first with a low-risk client. If that seems to work out and everything's fine, then you can go back through the deeper due diligence process prior to a wider rollout. This can help that bank get time to market, quickly test out a solution, make sure their clients are happy, make sure everything works, and then go back and do in parallel, do the deeper due diligence. From our experience, the days of banks building their own solutions are way behind us. Banks must either partner with a provider or buy a solution. In many cases, you see banks investing in fintechs as well. So I think in one of the prior JP Morgan quotes, he had called out, Plaid as a very tough competitor, and now they're an investor in Plaid on the other side of JP Morgan. But still, that's another aspect of getting closer with a fintech. Typically, banks separate those types of relationships between the investment and the operational side. But if the bank succeeds in this, they might as well participate in the upside of that too. If the bank makes it successful, they have an investment in that company, then they'll ride the wave with that as well. With a partnership approach, banks can achieve a much faster time to market and get their solutions to the clients faster than the competition. The starting of a partnership really is just the beginning. Signing that contract starts the partnership, but that's really the beginning of everything else. It's going to require a lot of alignment, a lot of resources on both sides, and communication to make sure that that alignment continues. With the right partnership, though, the banks and the fintechs can create this win-win dynamic. I do want to open this up for questions. I do want to thank everyone for attending this today, and thank you for MPC for having us speak again this year. I know we covered a lot in a short period of time. So I will, let's see, let me close my screen here and then bring up the questions. Okay, let's see if we get that working now. Okay, great. Let's see what we've got in here. We've got a couple of questions that are queued up here. So let me take this first one here. What is your view on these institutions that have either purchased a fintech or tried to create a platform? I think that it's interesting when you talk about US Bank here. I think they've done a little bit of everything. When a bank is that big and, they're a sponsor here too as well. I think that a big bank like that has invest, purchased, and partnered. So I think if you're big enough to do that and handle all that, that's a great strategy. Not all the banks have all the capital to do that. We have another question from Douglas Davis. How do you go about seeing a fintech partner that will give you the quality of service you need at a value that's worthwhile? Is there a monitoring organization that shares which are the top performers and which aren't doing so well? That's a great question, Douglas. I think that like any partnership, you really have to set those goals and objectives and how you're going to go about defining success. And when we partner with banks, every one of our banks has a slightly different approach to go to market with us. Ultimately, the banks want to drive fee income, continuous ongoing transaction revenue. And I think that those targets need to be set individually between the partner and the bank, and they're going to be different. And quality service is important. Banks are famous for their uptime. They should expect the same level of service from their clients as well and their partners. And I think part of that is having regularly there's a product management and sales and go-to-market people on both sides of the partner and the bank. Setting those standards, reporting on them, and then adjusting as needed. Next question here: how do you fight institutional paralysis that helps banks with your solution? That's a great question. I think there's a lot of deciding not to decide, and we see that as well. And I think the best way to do that, even when we're selling into new banks, we have to help them identify their potential clients even before the solution has been deployed. So we'll go out with our prospects to talk to their prospects to put this business plan together. And what we see is that when our banks, even though we're in a prospecting cycle with the bank, if we're able to pull through some real opportunities from existing clients, that helps that analysis paralysis and pulls this project to the top. There's nothing like a real live opportunity to get the wheels moving. We got one more question on here. How important do you feel open banking will be to the success of banks and fintech partnerships? That's a great question, because when we do an integration with a bank and companies like us that do integration with the bank, it certainly makes our integration much faster if the bank has established some type of open banking or APIs so that we can get into their payment systems, get into their all of their treasury management systems, their account analysis systems. I think that even just open banking though still requires a relationship with a bank. You just can't plug directly into a bank and never talk to them and start running transactions. So certainly the open banking part of that really helps an implementation project move very, very quickly. We've got another question here. We started an ATM program for banks, both on-site and off-site ATM solution. What the question we need to answer for building this relationship? That's a great question. So I think is really making sure that you have a champion in that bank that understands your go-to-market model, and that you're aligning with their go-to-market model. You want to install your ATMs and get transaction volume, and the bank, you got to find your champion there as well to align that with. I think that's just part of the relationship management, the constant discussion with not only your champion there, but the rest of the organization as well. I think we are at the end of our session here at 9:30. My contact info is here in this Whova platform. So if anyone has any additional questions they want to chat with me offline, please do so. And I look forward to following up with you after the conference. Thanks, everyone.